Okay, we're going to start with chapter 12. I'm going to go over 12 and the problems for 12 as well. And then 13, which is our last chapter. Okay, this is kind of a review of our other accruals and deferrals that we did on the previous chapter. I believe it was chapter 3. The only difference is we're going to use different accounts. Now we're dealing with merchandise instead of just service. So let's look through what we're supposed to determine here. It says we're going to be calculating merchandise inventory and adjustments on that. Accrued and prepaid expense items, which means accrued and deferred, because deferred means prepaid, and compute the adjustments for those accrued and deferred income items. It also says we're going to complete a worksheet. Now, you guys have already done a worksheet. It's part of your project as well. So that's nothing new. It's just a matter of different accounts that'll be on that worksheet. So the accrual basis of accounting is what most people use. What that means is revenue is recognized when it's earned, not when when the cash is received. So this is like accrual means using monies that are not necessarily cash, like accounts receivable and accounts payable. For example, for sales on account, revenue is recognized when the sale occurs, even though the cash is not collected immediately. That's the same thing as accounts receivable. You recognize the revenue when somebody has purchased something, not when you receive the cash from the customer. Okay. Expenses. Now, what about expenses? Each expense is assigned to each accounting period. Okay, so what they do is if you prepay an expense or anything like that, you need to assign it then to each month. It's referred to as matching the revenue with the expenses. Moving on, we're also going to learn about merchandise inventory, which we haven't really done much of before. So let's look at those accounts. Okay, so let's look at inventory. Inventory is considered, an asset. It's also an expense, really, because it's something you need to buy to make your sales. So it's a debit. Same with purchases, there are debits. And anytime you have a sales or revenue, all revenue is credit. That's all they're telling us here. Okay. This says, notice there are no entries made directly to the merchandise inventory account during the accounting period. Consequently, when the trial balance is prepared at the end of the period, the merchandise inventory account still shows the beginning inventory for the period. I'll show you why it shows the beginning inventory and not the ending inventory shortly. Okay, so let's take a look at inventory for a minute. Legally, every business has to count their inventory at the end of the year. It's part of the legal requirements of accounting. And what I mean is a physical inventory. So imagine you're a grocery store. You have to count every single thing in the grocery store, like every single box of cereal. In fact, I used to have a job like that. I worked for an inventory service. So because legally you have to have a physical count of everything in the store. Anyways, here we go. Based on physical account at the end of the year for Whiteside Antiques, it totaled $47,000. So what we need to do is make an adjustment. We need to use these two general ledger accounts to adjust the inventory, and that is merchandise inventory, and we're going to use the income summary account. So first thing we got to do is take that old inventory off the books, which is $52,000, because we know now that it's really $47,000. So to take it off the books, we have to make an adjustment, and we've got merchandise inventory, which is a debit. We're going to credit it so that the count's zero. And then we've got to debit something. So that's where we put it into account summary to help us close that merchandise inventory account. But now we've got to put the real inventory back in the books, which is $47,000. So we're going to go here. Now we have to make an adjustment to put the $47,000 in the books. That's the next step. So to do that, we go to the merchandise inventory account, which was zero now, and we put the $47,000 back into the debit side. And then, of course, we've got to credit that because you have to have a debit with a credit. So the income summary now gets a a credit. Okay, so now we're going to do a little bit of calculations before we complete what would be a new worksheet. We have to figure out how much of our accounts receivable will not be collected. Now, nobody knows. So you're running a business and you're like, oh my gosh, I have, you know, 200 customers on accounts payable. I'm wondering how many will not pay me. On average, I think most companies choose between 5 and 10% of those accounts being uncollectible. Most in this scenario, they're going to guess that 8% of the people are not going to pay their accounts payable or accounts receivable. So we estimate it. So how do we estimate it? We don't just pull a number out of the air. What we do, there are several methods, and you'll see if in a real accounting textbook, they'll give you about 4 methods that people use to detect how many people are not going to pay. But for this class, they just want you to use the most common method, which is the percent of net credit sales. So you take a percentage of your sales. Like say pretend you sell $1 million worth of stuff a year, and you say, oh, I think that 8% of the people aren't going to pay me. Then you got to go in at the end of the year and you have to guess that 8% and put it in the books. You do get to write it off as a company expense. Okay. And sometimes people will just base this rate on the previous year. They'll just look in their books and say, gosh, last year was only 10% didn't pay me. So why am I guessing 8% this year? You have to guess according to what's been happening so far in your company. So once you make that guess, like in this scenario, they want to say that our sales are 100,000, 8% of the people aren't going to pay. They estimate that that's a write-off of $800, and we open a new account called the uncollectible accounts expense for uncollectible accounts. We know expenses are debits, and we know that $800 is going to go now into a debit side equation. So what's going to happen next? What happens is we open this new expense account called uncollectible accounts expense, and we put the $800 debit in there because that's 8% of our sales. And then we need to open a contra account, what's called a contra asset account with it. And that is going to be called allowance for doubtful accounts. That's where the credit goes. Okay, you just keep a running total of that. So it already had a beginning balance from the previous year, and then you're going to add the 800 from this year, and you're just going to have a new balance. Okay, so what happens next now is what does that do to accounts receivable? Well, let's say you got 32,000 in accounts receivable. Now you know that you've got in your bank account that $1,050 you're guessing is not going to be paid to you. So your net accounts receivable is really only going to be $30,950. So if you were to go to the bank and borrow against your accounts receivable because you needed money, you would have to just tell them that your accounts receivable is really 30,000, not 32,000. Now we need to adjust for depreciation. What's the property, plant, and equipment depreciation? These are long-term assets that last longer than a year. And generally, when you list assets on the balance sheet, they go from the most liquid, that's why cash is listed first, to the least liquid, the hardest ones to get rid of, which would be your property, plant, and equipment. So those are always listed last. They're called long-term assets. Okay, here's the all the adjustments we need to make. We already know that depreciation, there are several depreciation formulas out there. There's the book value one we used in a previous chapter, but there are other ones as well. And you would learn all 4 depreciation methods if you were in an accounting class that's the next level up. Accrued expenses are those that have already incurred that you need to pay. Like people's salaries. They've already worked their 2 weeks. It's your job now to pay them. So that's what accrued means. It means that something that happened that you have to pay now on. That would be the salaries and the taxes and any notes payable that are outstanding. This is because these accrued expenses involve amounts that must be paid in the future. The adjustment for each item is a debit to an expense account and a credit to a liability account. And you'll see an example of that shortly. Like here, salary expense and salaries payable. There's your credit, your payable. All payables are credits. All expenses are debits. Same with the payroll tax. Let's say you've figured out your payroll tax, like in the previous chapter, and you know that's something that you have to pay. The adjustment will be in a payroll tax expense, a debit. Social Security payable, it's a credit. Anything payable is a credit. That's what the accounts would look like. Then you've got accrued unemployment taxes to pay as well. Nothing new. Federal tax payable. Anything payable is a credit. State unemployment tax payable. Any expenses a debit. Notes payable, you're not going to do notes payable till you hit like accounting 2. Accounting 1 doesn't really cover it much, but accounting 2 focuses a lot on capital equipment, depreciation, and notes payable. If you go further in accounting, you'll learn a lot more about it then, because we have to worry about here paying the interest on a note. So here we have to compute interest. We've got an interest rate and the time 1/12. That'd be 1 month worth of interest we have to write out. Remember, even though the interest is due at a lump sum when the note's over, you still have to account for it every month as part of your monthly expenses. And make that adjustment. Interest expense, $20. Interest payable, $20. Okay, those are all accrued examples. Now we have deferred examples coming up. Deferred means we've already paid it. Something that was prepaid, like prepaid insurance or prepaid supplies. So the prepaid expenses are called deferred expenses. Prepaid supplies, prepaid insurance, prepaid interest on notes payable. Could be like a prepaid magazine subscription. Maybe you paid for the New York Times for the whole year. That's a prepaid expense. And then this examples, we're going to do some of these adjustments. Oh, they don't even have any examples for us to do, but we did them in other chapters. You'll see on the worksheet. What is accrued income? Income that has been earned but not yet received. That would be something like a note coming back to you. Income that is earned, like the interest on the note. You earned it, you just haven't received it. Here's an example. Accrued interest on notes receivable. You earning interest day by day on a note out there. At the end of the period, recognize, you'll make an adjustment to recognize the interest income earned, but not yet received or recorded. So we're going to have a couple notes payable problems, and you'll see that as well. Sometimes, this 2 out of 12 means compute for 2 months. So you figure it for 1 month and times it by 2. But the important thing is what accounts are affected, right? What gets the debit, what gets the credit? That's the hard part for everything. So we're going to debit interest receivable. It's interest that we're going to receive on our notes. And we're going to credit interest income. All income is always a credit, right? And all payables are credits. These are examples of things that are deferred, which means prepaid. Income that comes into us that we need to make adjustments for. Okay, it says complete a 10-column worksheet. And you guys have already done a 10-column worksheet. But let's take a close look at this one. Okay, so I'm going to go ahead and see if it doesn't let me zoom in. Let's see. If I go like this, and I try to zoom in and see, there's an income summary account under the drawing account. Okay, that wasn't there before. We have a sales. This is very different from your project because now we have sales return and allowances, which is something that you don't have on your project because we're not dealing with merchandise on your project. Once you deal with merchandise, you have things on here that you haven't seen before, which are purchases, freight, purchase return and allowances, purchase discounts, salaries, all kinds of stuff that we haven't even done on our 10-column worksheet. Okay, but let's talk about these balance sheet columns and stuff. Identify the accounts that appear on the balance sheet: assets, liability, and owner equity. We already know that. Also include the owner's drawing account on the balance sheet section, and that's new. On the income statement, you have the revenue and expense. And that's kind of all they want you to know for this chapter. It's stuff that you've covered, just those couple new accounts that haven't dealt with before. So let's go ahead and do the homework. I'm going to pause the recording and pull up the homework. Okay, I pulled up the exercises for chapter 12. Number 1, the beginning inventory of a company is 141 and the ending is 118,519. What entries are needed to adjust the fiscal period to merchandise inventory? Okay, so the first thing you're going to do is close the beginning inventory. You know, inventory is a debit, and to close it, you're going to credit it to the income summary. So that would be a debit to here we go. And the second thing we're going to do is we're going to go ahead and open this. You'll see. I'll show you what I mean. Let's just pull it up. Okay, so merchandise inventory is normally a debit, so you need to credit that. Let me see if I can zoom this. Okay. All right. Merchandise inventory is normally a debit, so you need to credit that for the 141. What we're doing is we're closing out the merchandise inventory account because we took a physical count and realized that's not the amount it's supposed to be. Then you're going to go ahead and you have to debit something, so you're going to debit the income summary. Now you need to open the new balance in merchandise inventory. So you put on the debit side what the real inventory is, which is 118,519. And then you also need to make a credit. So you'll put that credit in the income summary account. And that's your answer to exercise 12.1. Okay, let's look at 12.2. The income statement of Johnson Company worksheet for the year December 31, 2019 has 199,000 recorded in the debit column and 215,345 in the credit column on the line for the income summary. What are the beginning and ending balances for merchandise inventory? So that's just the opposite. It's the same problem, just reverse. So easy. The beginning merchandise is 199 and the ending merchandise is 215. The beginning merchandise is 199 because why? Because that's what we had to close out in the income summary account. And then the new, that's what we had to close out, I'm sorry, in the merchandise inventory account. Leaving the balance in the income summary account 199 for the debit side and the credit side being 215,345. Okay, so it's the same problem as 12.1, except that we wrote it out instead of made it a journal entry. Okay, let's look at 12.3. Compute the adjustments for uncollectible accounts, depreciation, and payroll. Okay, so A, we have got a net credit sales of $1,950,000. Past experience shows 1.5% of that firm's net credit sales results in uncollectible accounts. So you take the sales, you figure out 1.5% of that. You're going to put it in two accounts. It's going to be uncollectible accounts expense and allowance for doubtful accounts. Those are the two accounts we need. You know the expense is the credit, and you know the allowance for doubtful accounts is the debit. The debit is the expense. So here's your first answer. 29,250 will be 1.5%. That means we have an uncollectible accounts expense of that amount, and allowance for doubtful accounts is our credit. And that's how easy it was. Well, next one, let's look at depreciation. Equipment purchased by Park Consultancy for $38,000. Let's see, it's an estimated useful life of 10 years and a salvage value of $2,700. What adjustment for depreciation should be recorded on that firm's worksheet? This is where I need my calculator. Let me see if I can. I'm going to have to pause and go grab one. Okay, we're going to compute the depreciation. So what you got to do is you take your $38,220 and you take the salvage value. That's what it's going to be worth after 10 years. So it's $38,220 minus $2,700 and then divide it by 10 years. That is going to be your adjustment for depreciation for 1 year. It means every year it's going to be the same amount for 10 years. Every year that you do the books. Okay, so let's look at what that looks like in Excel. That means we've got depreciation expense down here. Equipment, that's what we're depreciating. It's going to be $3,552. All expenses are debits. That gets listed first. Then the contra account that goes with it is accumulated depreciation, 3,552. Okay, the next problem. On December 31, Giant Plumbing owed wages of $11,400 to its factory workers who are paid weekly. So they owe these wages. So what accounts will be affected? It means that they owe the money. So that's an expense. And they haven't paid it yet. So that's a payable, something that they owe. So the expense gets listed first. There's your wages expense, $11,400, and your wages payable is what you owe. Now that you've got their salary out of the way, now you got to take the taxes out. So that's the next part. On December 31, Giant Plumbing owed the Social Security 6.2%, Medicare 1.5%, taxes on the entire $11,400 accrued wages for its factory employees. So after you do the math, this should be the answers. Payroll tax expense, $872. Social Security payable that you need to pay, $706.80. Your Medicare tax payable is $165.30. Okay, we have more payroll tax expense in the next problem. We now have to deal with federal and state tax. So in the next problem, here we go with the federal tax at 6% and the state tax at 5.4%. And the unemployment taxes as well. Oh, and the state unemployment taxes, excuse me, federal and state unemployment taxes. And you're taxing the $11,400. You know, from running a business, you will find that the payroll taxes are like almost like the biggest expense of running the company. It's just insane. Okay. Here we go with the payroll tax expense again. Now we have the federal unemployment tax at $68.40 payable. These are all payables, which means you owe money on them. And state unemployment tax at $615.60. Okay, let's move on to the next problem. We are now up to 12.4. And let me zoom in so I can see. Okay. 12.4. For each of the following independent situations, indicate the adjusting entry. Okay, let's talk about adjusting entries. You'll find on the project, on your final project, and in the real world, that's where 99% of the errors occur. So anybody who has sent me their project and said, help me, it's always, always, always the adjusting entries that are wrong. Especially the first two are very confusing. So that's where people probably need the most practice. So let's go ahead and go over these adjusting entries. On December 31, notes payable account had a balance of $16,000. This represented a 3-month 7.5% note issued on November 1. So now we have to make an adjusting entry for December 31. Okay, so let's see what they did here. Okay, they figured out the interest expense and the interest payable on the note. They say it's $200. We got to figure out why it's $200. It's $200, 7.5% of that 16,000. Let's do that math. Okay. The note would be 100. Oh, it's a 3-month note. Okay. So the total interest is $1,200 divided by 3 months is 400, and they are saying it's 200. Oh, it was issued on November 1st. That's why. Okay. So we have to count the entire month of November, and we have to count the entire month of December. 2 months interest. Okay, so let me do the math, and let me pause it so I don't waste your time. Okay, so let's look at the 16,000. The interest on that note for a whole year would be $1,200. In this case, this is a 3-month note. We only need to account, so for 3 months, $1,200, and divide that by per month is $100 a month, correct? And in this case, $100 a month is your interest on this note. But we have to account for all of November because it started November 1st, and the interest for all of November and the interest for all of December. So that's 2 months. So 2-month worth of interest is $200. So this is why we've got the interest expense at 200, the interest payable at 200. Okay, let's go on to the next one. On January 2, high-tech company consultants purchased flash drives, paper, other supplies for $5,230 in cash. On December 31, an inventory supply shows items costing $1,500 were on hand. The supplies account balance is $5,200. Okay, so we need to make the adjustment for the difference between what we have on hand and the inventory that was used. Okay, so I'm going to go 52. Let's see. Clear. 52, 30. Okay, so what we're going to do is take our 5,230 and we're going to subtract what we have left, which is 1,590. So we need to, that means how much we used. That means we used 3,640. So because we used it, it's a supply expense. So there should be supply expense 3640 and supplies credit that because we used them 3640. So let's see what we have for an answer. Yep. Supply expense 3640 and supplies 3640. Okay, let's look at the next one. Oh, where'd my book go? There we go. North Dakota Manufacturing paid a premium of $14,600. Okay, so this is a prepaid insurance policy, $14,640 for 1 year of insurance. On December 31, an examination of the insurance record showed coverage for a period of 4 months had expired. So 4 months. So they're saying we bought it in September, and we have to account for 4 months: September, October, November, December. So that means I would take the 14,640 divided by 12 and then multiply it by 4. So let's see what we get. I get 4,880. That means I used 4,880 of insurance. So that would be insurance expense, 4,880, and insurance. And that's correct. Woohoo! Here we go. Insurance expense we used was 4,880, and prepaid insurance went down by 4,880. Okay, and the last one, we have a 1-year advertising contract with the radio station. We issued a check for $10,800 to pay the total amount, but on December 31st, the prepaid advertising account has a balance of $10,800, so we have to adjust for how many we used. Okay, so we paid for a full year. That would be $10,800. So it's divided by 12. Clear. 10,800 divided by 12 is 900. And how many months did we use? May, June, July, August, September, October, November, December. 8 months. That means 8 times the monthly cost should bring us $7,200. So that would be $7,200 in advertising expense. So let's look at our journal. We have advertising expense, $7,200, and prepaid advertising goes down by $7,200. It's not so bad. Okay, 12.5 are more journal entries. I wonder if I should have you guys just figure that one out. Well, you can look at it, maybe do 12.5 on your own, 12.6 on your own. See if you can just scroll through and figure out 12.5 and 6. 12.5 might be a little bit more complicated because you're about notes. And 12.6, you're going to just figure out the interest on a note. So it's just simple math. Let's move on to the actual problems that take a lot of time. Ah, 12.7. I forgot that I went all the way to 12.7. What did we do here on 12.7? Oh, these are the deferred adjusting entries. We should probably do those. Okay. Let's move on to 12.7. Accrued and deferred adjustments. December 31, the notes receivable account had 40,000, which represented 6-month 5% note on customer on October 1. Okay, so that means we have to count all of October, all of November, all of December. That's 3 month worth of interest that we have to count. This is a 6-month note, so 40,000, 5%. Okay, 40,000 times 5% is 2,000. It represents a 6-month note. Okay, that 2,000 divided by 12. That means each month is 166.66. Wait, what if they did? Round it off. Oh, they got 500. I must have oh, the 2,000. Okay. Yeah. All right, I'm going to go back and figure that one out. Just let me pause. Okay, looking back at this notes receivable, it has $40,000. So you multiply that by the 5%, and you'll get 2,000. You take the 2,000. That's how much the interest is per year. Divide it by 12. It comes to $166.67 a month. But 3 months has gone by. All of October, since October 1. All of November, all of December. So 3 times 166.67 will give you the $500. And that's what you'll make the adjustment for in the accounting to look like that. All receivables, debits, interest, income, all income at all is always a credit. Okay, the next one. On June 7th, they received $75,000 from customers for subscriptions. On December 31st, analysis of unearned subscription revenue account shows half the subscriptions were earned. All you're going to do is put that in half. And we have some revenue. See, you earn revenue and don't record it. You move it over after it's been used. So unearned revenue, 37,500, and the revenue used, 37,500. See? They have a building. They received $36,000 in advance to cover the rent for 6 months. Upon receipt, the $36,000 was recorded in unearned rent revenue. So this is rent for 6 months. So $36,000 divided by 6. And then for how many months went by? From June, during the week of June 7th, on December 31. So for half of this, okay, wait, 30 for rent. November 1. So we have to account for 2 months. So 36,000 divided by 6 times 2. And that would be 12,000. Here we have unearned rent of 12,000, and then our rent income so far has been 12,000. And the last one. The Mighty Bucks Hockey Club sold their tickets for 50 home games, received $9 million. Upon receipt, the $9 million was recorded in the unearned season ticket income. See, because the season hasn't started yet, so it's unearned. At December 31, the Mighty Bucks had played 5 games, so how much money has been used? All right. So for how many home games? 50? Take that 50 home games and divide it by the 9 million. Account for all of November and all of December. That's 5 home games. And you should get $900,000. So you're just going to put unearned season ticket income and ticket income that has already been used and earned as your credit. The 5 games. Okay, what else had I assigned? 12.7 was the last exercise. There was 12. We don't have any problems in chapter 13. So once you get through these 12 problems, all you have in chapter 13 are the actual exercises. They were all general journal entries as adjustments. And also when you do your worksheet on your project, you need to put the A, B, C, D so you know what adjustment is what. Adjustments are really good practice. If you could adjust probably just 12.1. I think I might, let me see what the other ones are. 2, 12.2, 12.2a, 12.2.3. They did it on the worksheet. Okay. Well, I think what we should do is skip the whole big worksheet thing and just do 12.1a. and 12, 2A. I'll put them up right now so you can look at them, but I really like you to try them on your own. For me telling you the answers doesn't really teach you anything. But you can read through an adjustment and see what it means along with your book. Read how to calculate notes and things like how we did the math on the other problems is the same the way it's going to be how we do the math here. And then on 12A, 2. And then we're going to do 2A continued. And then that's it. So we're only going to do 12-1A. That's 12-1A. Do 12-2A. And that's 12-2A. And stop. Don't do the whole big worksheet. You got enough to do on your project. So I'm just going to sum this up for 12, and I'm going to go ahead and move on to 13. 13 will be a lot shorter. And again, you won't have any problems in 13, just the exercises. So let me get started on that.